It's a pretty impressive stretch now that these cyclical commodity-linked companies have put together basically about a month of real outperformance. Can this be sustained? Or maybe the better question is, what would it take for this outperformance to be sustained? Because, of course, on the longer chart, they're still down massively, massive underperformers.
Sure. One name that I've been really focused on Joe, has been U.S. Steel, which was, frankly, a stock that was not trading well before COVID, and nor were steel prices, which really determine its top line and its earnings there. And of course, COVID didn't help matters anymore. But the way I look at this particular name is that the stock was left for dead. Every analyst hated it. But steel prices, were quietly sort of skyrocketing.
Yeah.
In other words, just in late August, they were $450 a ton. Today, they're $820 a ton. $820 a ton is a nice price for steel, if you look back over the last 10 or 15 years. But the stock is I think it's just started climbing here. So I would say there's, you ask what is needed for U.S. Steel that's, basically double, it was up 10% today. It's doubled just in the last few weeks. What's needed for it to go higher? Really, I think you can make the case that steel prices need to they don't need to go up much more. They just need to not collapse, right? And I think for me anyway, as more of a macro analyst, I can feel pretty comfortable that steel prices are probably not going to collapse, not in the near to midterm anyway. So
Iron ore was at a record high today. We've had Dr. Copper continuing to show its optimism surrounding the economy. Where are some clever places to be playing this at the moment that perhaps haven't been swept up in the fervor that we've seen thus far?
Yeah, it's funny. I think there's been, I think you have to look at each name differently. You may have seen platinum was just breaking out. That's a precious metal it's a bit different than gold and silver in some respects. I think you have to look at things, a little bit, really sort of case by case here. I got very comfortable with owning U.S. Steel, and I'm still long it, and I'm recommending it to my clients. I think it could either easily go up. It could easily double here based on its, basically some key assumptions holding together, which I think they will. I think when you get into the energy names, I think it's a little bit different there. And I think you have to be a little bit careful about what is a big tactical bounce and what is sort of maybe a longer term investment there. So I think it really comes down to your time horizon here. But look, I think, right now, I think you can make a more obvious case to buy a mispriced materials name like U.S. Steel, then it may be a little bit more obvious than buying an airline or something that really is so much more dependent on a vaccine recovery. A lot of these names can benefit just by simply, by some fiscal stimulus coming together, by the fact that inventories were way down and so forth. If you are trading in the shale names or in the majors in oil, you're obviously taking on a lot of oil beta there, and that's a very different type of discussion, and it's a pretty complex one. And I'm not an oil analyst, but I don't necessarily feel wonderful about thinking that oil prices are going to, keep rising here into 2021. So I think you have to be very careful, and it's very, very much a sort of a single stock by single stock basis. I think one point I would make from a more of a macro point of view is that what this rotation is revealing is that stock picking is real, and sector picking is extraordinarily important right now.
Yeah.
The tide's lifting a lot of boats, but the alpha is really made on the single stock basis right now.
Yeah, absolutely. And then when you're sort of looking at that macro picture, Michael, are you focusing a little bit more on the consumer spending side of this recovery or the business spending side of this recovery? Are there certain areas that you think gives a little bit more clarity as to the pace of that recovery?
Look, I think, from an overall economic picture, obviously the consumer is really important. The consumer has been, sort of surviving this pandemic better than certainly a lot of expectations there. I think at some point, though, the consumer, the corporate spending rather, seeing a more of a commitment to capital expenditures is going to be really key. And I think you can flash back to 2018 as an echo of what we're sort of seeing right now. Right now, we have this sort of vaccine stimulus, if you will, maybe some fiscal stimulus to help lift us out of this very severe economic contraction. 2018, you had this notion that we were going to return back towards sort of like an above trend growth after the tax deal was passed.
Right.
And that really just lasted 6 months, right? And then you had all those usual structural forces coming back into play again. So from the macro side, I think there's this echo of 2018 and 2021. And I think you have to be careful and watch the corporate spending and the commitment to fixed goods, the commitment to capital expenditures. How is that really growing, and how much is that going to be changed by COVID behavior and so forth?
Michael, real quickly, and you just have about a minute left, but going back to the materials and some of these cyclicals, I mean, one way some of these prices of commodities can really run is if there was significant underinvestment and diminished capacity, in the past, causing this kind of price squeeze. Do you feel that, even pre-COVID, we knew that a lot of these industries, like steel, like other commodities, really suffering probably diminished investment, closing of different facilities. Does that, in your view, make this run more sustainable because there just isn't the supply capacity like there may have been in the past?
Yeah, no, sure. Look, I mean, the commodity theme, you go back to 2010 and, or 2007 and 8, metals and oil were going to go ever higher because of the China notion. And then when China backed off that and we started getting that transformation in the Chinese economy, we went into sort of a commodities bear market that ultimately resulted in a lot of supply contraction across the spectrum, from copper and, to steel and so forth. Ultimately, those supply contractions will change. U.S. Steel is just, opening a plant right now, right? So I think you have to look at all of these materials names in the context of a very powerful bounce, as opposed to necessarily, we're in a whole new world order where you have to have a 5-year overweight to commodities. I look at this as how do you navigate alpha in the near to intermediate term, and not necessarily something that you just stick in your 401k and forget about for 5 years.